Below the flickering numbers on trading screens, the global stock market is moving like a living organism, exquisitely sensitive to fear, expectations, power, and trust. What we are witnessing is not a routine market correction, but a moment in which multiple layers of conflict are overlapping and reinforcing one another. Geopolitical tensions, policy conflicts, and, most critically, an institutional conflict unfolding at the very heart of the world's financial system. The market is no longer merely pricing companies or growth prospects. It is quietly repricing the foundations of power that support money itself and the global financial order built around it. In the United States, the sharp divergence on Wall Street is the clearest expression of this capital reallocation. Heavy profit-taking in large-cap technology stocks, long the backbone of the multi-year bull market, has pushed the Nasdaq into the deepest decline among major indices. By contrast, the Dow Jones has slipped only modestly, while the S&P 500 has posted a more measured pullback. This pattern reflects a shift away from high-growth names toward more stable companies with predictable cash flows and less dependence on distant future expectations. Particularly striking is the strength of small capitalization stocks, which have reached record highs, suggesting investors are actively searching for opportunities that are less stretched by perfect expectation pricing than the largest technology giants. At the sector level, this rotation is unmistakable. Technology stocks are not being sold because their long-term narratives have collapsed, but because valuations have absorbed too much optimism at a time when real interest rates remain elevated and policy risk is rising. Defensive sectors, such as consumer staples, utilities, and healthcare, have shown relative resilience, offering stability in an increasingly uncertain environment. Financial stocks, after a strong run last year, have entered a largely technical correction. Earnings have been solid but not spectacular, insufficient to justify prices that had moved too far ahead of fundamentals. Added to this are policy proposals related to credit card interest rate caps and consumer protection, which have revived concerns about future margins. Still, over the medium to long term, banks are broadly viewed as fundamentally sound, provided the U.S. economy avoids a deep recession and the labor market remains resilient. Energy stocks, by contrast, have emerged as a relative bright spot. Rising oil prices, driven by concerns over potential supply disruptions in the Middle East, have supported the sector. This dynamic underscores a familiar pattern. In periods of heightened uncertainty, capital gravitates toward industries that directly benefit from geopolitical stress and cost-push inflation, even if global growth prospects appear fragile. What has truly unsettled global markets, however, is not economic data. Inflation indicators have largely met expectations, and retail sales have surprised to the upside, reinforcing the view that U.S. demand remains intact. Under normal circumstances, such data would stabilize markets and support risk appetite. This time, investors have responded defensively because the center of concern has shifted away from economics and toward institutions. The Federal Reserve Chair's forceful defense of central bank independence against the backdrop of an investigation into the costs of renovating the Fed's headquarters, widely perceived as politically charged, has touched the deepest nerve in global finance. For decades, U.S. assets have been regarded as the ultimate safe haven, not only because of economic scale and strength, but because monetary and fiscal decisions were believed to operate within a relatively independent, rules-based, and predictable institutional framework. Once that belief is questioned, market reactions become swift and instinctive. The U.S. dollar weakens, Treasury yields rise, gold reaches new highs, and equities come under broad selling pressure. These are classic signals of a system being assigned a higher risk premium. The real danger does not lie in whether interest rates rise or fall over the next few policy meetings. It lies in the possibility that the long-term cost of capital in the United States is being repriced. If investors begin to believe that monetary policy could be subject to political pressure, long-term inflation expectations rise, forcing real yields higher to compensate for institutional risk. Ironically, this very pressure may make the Federal Reserve more cautious about cutting rates as policymakers seek to demonstrate that decisions remain data-driven rather than politically influenced. The result could be a more prolonged period of tight financial conditions and elevated market volatility. Turning to Australia, the impact of global tensions is visible through a different but equally revealing lens. The Australian equity market is dominated by two pillars: resources and banking. When energy and commodity prices rise on geopolitical risk, mining stocks benefit in the short term, but they also face vulnerability if slower global growth weakens demand. Australian banks, traditionally seen as stable and dividend-rich, are highly sensitive to global interest rates and currency movements. Uncertainty surrounding U.S. monetary policy has increased volatility in the Australian dollar, forcing investors to reassess foreign exchange risk and portfolio allocation. In this environment, infrastructure, utilities, and businesses with long-duration, predictable cash flows have emerged as relative safe havens. Asia presents a distinctly multi-speed picture. Japan continues to benefit from a weak yen and prolonged monetary accommodation, yet remains highly sensitive to movements in U.S. bond yields. South Korea and Taiwan sit at the intersection of the global technology cycle, particularly semiconductors, and have felt the impact of tech sector adjustments, even as long-term AI and automation themes remain intact. China is moving to a different rhythm altogether, driven by domestic policy measures, selective stimulus, and ongoing efforts to restructure its property sector. While international investors remain cautious due to policy uncertainty and fragile confidence. Southeast Asia has gained from supply chain diversification but is not immune to global capital retrenchment if risk aversion toward U.S. assets intensifies. Across Asia, a common theme is emerging: a growing emphasis on domestic resilience. Stronger internal demand, proactive fiscal policy, and financial system stability are becoming strategic priorities as confidence in the global financial order is tested. Economies are increasingly seeking to reduce dependence on any single center and diversify their economic and financial relationships. Across all markets, capital flows are telling a remarkably consistent story. First, technology and high-growth stocks remain compelling over the long term, but are prone to sharp, short-term volatility when interest rates and institutional credibility come into question. Second, financial stocks serve as a direct barometer of policy expectations and systemic stability, making them vulnerable during periods of heightened uncertainty. Third, energy and defensive sectors function as psychological anchors, helping portfolios withstand periods of stress. In such an environment, effective investment strategy is less about precisely timing market swings and more about portfolio structure and risk discipline. Geographic diversification, balance between growth and defense, and a focus on companies with strong balance sheets and durable cash flow generation are more reliable approaches than chasing short-term narratives. Gold, energy, and other hedging assets can play a stabilizing role, while value stocks and smaller capitalization names offer selective opportunities for patient investors. Ultimately, what the market is testing today is not just earnings forecasts or GDP growth rates, but trust in the institutional foundations of the global financial system. In a world where conflicts are increasingly layered and interconnected, stock markets have become mirrors reflecting not only economic realities, but the degree of confidence that societies place in the order governing money, power, and decision-making itself.